Well, stocks snapped a 6-week winning run last week as some jitters crept in and de-risking took hold of financial markets, which also saw some selling across the Treasury curve as well, even as the dollar continued to advance to its best levels since early August. A blockbuster fortnight now awaits market participants, with this week bringing the budget here in the UK, a policy decision in Japan, the latest US jobs report, plus, of course, 5 of the Magnificent Seven reporting earnings. And next week is just as busy, with the presidential election looming large, just a week away now, plus, of course, decisions next week from the FOMC and the BOE. There is no shortage of things for myself and Ryan Littlestone to discuss on the trade-off this week. So without further ado, let's crack on with the show. So an incredibly busy fortnight lies ahead for the financial markets, and joining me to try and make sense of it all is my good friend Ryan Littlestone from Forexpo Live and Forex Analytics. And Ryan, the week has already begun with a scalp of sorts, with your team West Ham claiming Erik ten Hag's position as Manchester United manager already.
Yeah, we are absolutely massive, mate. Good to put pay to something at Man United anyway, and a deserved win for us. And you managed to scrape a draw against what could be the new champions.
Yes, indeed. I think our hopes of winning the title are about as slim as the chances of any tax cuts in the budget on Wednesday, aka non-existent.
Yes, well, we shall see about that. But yeah, it's good to see you out the race this early in the season anyway.
Well, I'm not sure I'd use those words. But anyway, we've got far too much to be talking about, to be waffling about football all day. So let's crack on with Topical Thunder. So we may as well get the bad news out the way early and talk about the budget, because it is going to be pretty grim on Wednesday, you would imagine. Of course, that is when Chancellor Rachel Reeves stands up in the Commons and gives the first Labour budget for 14 years. You've got to go back to 2010 for the last time a Labour Chancellor delivered a budget. And of course, it's the first time a female Chancellor has delivered a budget in the history of the office. It is, of course, likely to be a very significant event. And to be honest with you, for those of us living in the United Kingdom, it's likely to be a pretty grim event as well. Chancellor Reeves and the Treasury are reportedly seeking as much as £40 billion worth of tax hikes and spending cuts. There are two reasons for that. The first is to plug this supposed £22 billion black hole in the public finances. And the second is to build up a greater degree of fiscal headroom, which per the current rules stands at about £9 billion, which is the lowest level in the last few decades. In fiscal terms, that is absolutely no margin whatsoever. Those tax hikes, what are they likely to include? Well, pretty much everything, to be honest with you, that isn't either salaried income or VAT. We're looking at an increase in capital gains tax, a possible increase in fuel duty, some changes to the inheritance tax regime. But the big one will be employer national insurance contributions, which are likely to be increased by between 1 and 2 percentage points. And also there's the potential for national insurance to be levied on employer pension contributions. We're also likely on the spending side of things to see a real-term freeze in many government departmental spending budgets outside of those which are protected, such as defence and health. If you're sat there going tax hikes plus spending cuts, that sounds familiar. Yes, it is. It's called austerity. We've been here before. That is not all, though, on Wednesday. We're also likely to see a change in how debt is measured. Now, this is going to get quite technical, but rather than simply looking at debt and comparing it to GDP, we're now going to measure our debt using a metric called public sector net financial liabilities, or P-snuffle, as some people are calling it, which I pledge never to repeat on the trade-off ever again. In short, this nets off borrowing against assets and increases fiscal headroom by about 50-ish billion quid. And the idea is that the government are going to use that increased debt to invest, capitally invest in the economy, with a budget of around 2.5% of GDP having been pledged in investment. When you put those two things together, the change in the debt metric and the 2.5% of GDP, that's likely to lead to an additional £70 billion in borrowing over the next 5 years. There is also a mechanism by which this change in how debt is measured, because you're netting off debt against assets, you could theoretically conduct limitless government spending if you were to sell some gilts and then use the proceeds of those gilts to write a loan to a sort of arm's length government body such as Great British Energy, who are supposed to be building a shed load of wind turbines, or this new national wealth fund that we're supposedly getting here in the UK as well. I think the budget is perhaps being underplayed by financial markets at the moment. For the pound, I would say that downside risks are pretty chunky given the significant tightening in fiscal policy that we're likely to see. And for gilts, well, I think the market is really on edge because, as we said, we're moving to a debt metric that is pretty hard to understand, let's be honest, and I spent most of the weekend trying to get my head around it. And secondly, a process by which the government could, in theory, spend as much as they want. And, well, we saw in 2022 how badly that ended up. And I think the Chancellor, when she stands up on Wednesday, is going to have to be walking a tightrope and going to have quite a difficult job to convince markets that this is not just the government turning on the taps and borrowing limitlessly.
Yeah, well, you've done a great job, mate, in digging into all the details and explaining what it all means. I'll try and attempt to wake up the viewers now and try and put that into some sort of trading terms that we can look at. No, but I mean that respectfully. You did a great job there. But you know, for most people, they're going to be snoozing off through this budget and talking about all that sort of stuff. So I'd always look at this thing from a trading perspective, from the pound's perspective. Yes, we have this moving of the fiscal goalpost, rewriting the rules that effectively can give them limitless spending. That's why the gilt market is a little bit jittery, as you say. I think for those watching from the outside, we've got to, if we hear from her, if she's going to put a limit on this limitless spending, if she turns around and says, yeah, we've got an open checkbook and we're going to use it, then the gilt market's going to crap the bed and probably the pound with it, because that would just mean an explosion in debt. But if she puts some sort of limits on that, saying, yes, we've got this room, but we're going to be very careful in using it and we're going to use it sparingly and just when we need to, then that's going to be a positive. So that's that side of things to look at for trading the pound. For the rest of it, taxes. Obviously, market investors, they don't care about, how much a price of a pint is going up or whether the bus fare cap is going up £1 or not. That's irrelevant to investors. Capital gains is obviously very relevant. Potentially inheritance tax is relevant as well. We're still not out the woods on what they're going to do to non-doms, whether they're going to hit them hard. They said they were going to hit them hard in their manifesto or in the campaigning, then they've sort of eased off a bit on that as well, but there could still be something coming from that. What they do with property taxes, which falls a bit into the capital gains, but there can be some other moves they can do. A lot of foreign firms own a lot of property, particularly in the city, industrial estates, things like that. So there's a lot to look at. So if you're not from the UK and you're not interested in the tech side of things, you're interested in the trading side of things, those are the important factors you need to look at and whether they're positive or negative, because that's really what's going to affect the pound.
Indeed, yes. Well, it's a little bit of a political shambles here in the UK and across the world. Even that bastion of political stability, Japan, looks to have fallen flat rather over the weekend.
Yes, a bit of an own goal over there in Japan. The new PM Ishiba, he took a bit of a punt pulling a snap general election just after taking over. Now he's lost his majority in the lower house, which is a bit of a big deal. They're now in political limbo for potentially the next 30 days, but something might get cooked up when the Diet opens in 11th November for a special session. So they've got 30 days really to form a government, but it looks like they may be trying to kick something together for the 11th of November. So that's a date for your diaries. The choice is now for Ishiba and his party to form perhaps a bigger coalition, even though Ishiba has said he wouldn't look for that, or the other alternative is that he could, in fact, govern without a majority, which they can do, obviously, as incumbent government, but it obviously means they will struggle to pass anything. The bigger issues for now, obviously, is how will the BOJ react? They're expected to do nothing at their meeting on Thursday. And really, it's this political mess that may decide their future decisions as well. They've got a government at the moment who are supportive of what they're doing. It's possible that there's a change in the LDP leadership again, maybe to someone more dovish like we had in the runoff. Then the real pressure will be on, and the yen is likely to weaken. The same move will happen should the wild card happen, and there's a complete change in government. That's a very low risk that they don't form a government or stay in power, but it's a risk nonetheless. So if we come out of this pretty much with the status quo as it is now, the LDP in charge, being able to pass laws, support the BOJ, keeping their leader, then we could see a decent bid in the yen, because it will mean that the BOJ is okay really to stay their course. Of course, where something like dollar yen is by the time that happens, what with the US election to come is anyone's guess. So we could find a bit of a bid in the yen if things do get sorted out amicably, shall we say. But as for what levels that's going to happen at, that's open to question.
Yeah, it's definitely an interesting one, and certainly came as something of a surprise. I mean, you mentioned the possibility of a change in the leadership in Japan and a new party coming to power. It's only on 2 occasions since 1955 that the LDP have not ruled Japan in one way or another. So they are, for all intents and purposes, a one-party state. And the last time this happened, which I think was 2009, Japan went through a spell of 3 prime ministers in as many years. When the LDP weren't at the helm. And of course, after that came Shinzo Abe, who was there for forever, effectively. So I think it is an interesting one. The negotiations are obviously going to be pretty drawn out. But I do think this is a bit of a dent to the sort of Japan bull case that had been gathering a lot of steam. One of the big underpinnings of that bull case was the idea that Japan was going to display considerable more political stability than its DM peers. You look at what's going on in Europe, here in the UK, and also the US with the election coming up next Tuesday. Japan was very much an outlier in terms of having that stable bedrock of a government. And well, that's not there now. So I think the Nikkei could be on shaky ground, and the yen could be as well.
Yeah, talk about shoot yourself in the foot. And it's something a lot of prime ministers do over there. If there's a change in leadership, they like to call a pretty quick general election just to sort of cement their position moving forward. But this one's definitely backfired.
Yeah, well, his cement didn't even dry by the time the wall was knocked down. But anyway, moving on to the jobs report, because, of course, it is the first Friday of the month, the first Friday of November. Where the hell has the year gone? But it does bring the October US labour market report. And, of course, that comes right in the middle of this risk event bonanza that we're all dealing with over the next couple of weeks. And I'm sure Ryan is going to go into more detail on some of those other events in a moment or two. Headline non-farm payrolls expected to have risen by just 110,000 in October, quite a chunky decline from the 254,000 that we saw in September. But there's a couple of one-off factors that are dragging this number lower. Firstly, we had the impacts of Hurricane Helene and then Hurricane Milton, which impacted states in the south of the United States. Helene was in North Carolina primarily, and then Milton hit Florida, and Milton actually arrived in the survey week. Those hurricanes together are likely to drag payrolls lower by somewhere between 50 and perhaps even as much as 100,000 if you listen to the estimates from Fed Governor Christopher Waller. You've then got the impact of several strikes that have been going on across the United States recently as well. Boeing are, of course, the most notable, probably about 30,000 off the payrolls print from them alone. And then, of course, you've also got the sort of domino effect down the Boeing supply chain that they may have caused. So some pretty sizable downside risks to the number. Initial jobless claims rose by 20,000 between the two survey weeks, September to October. Continuing claims, they rose by 70,000 over the same period. So if we were to get a miss, then don't read too much into it, because it is going to be heavily skewed by these weather and other one-off events. In terms of the other parts of the report, well, average hourly earnings, they're expected to have risen by 1/3 on the month, down from the 0.4 that we saw in September. Although do bear in mind that there is some upside risks to those figures if those hurricane-related job losses we were just talking about are skewed more towards lower earners. Think back to what we saw at the start of the pandemic when average hourly earnings growth shot through the roof. It was because job losses were mainly those on lower incomes. Unemployment, that's expected to hold steady at 4.1%. Participation, that is also expected steady at 62.7%. But again, the weather could dent some of these survey response rates, which could then cause increased volatility in that data. I think for markets, as with the September report, it's going to be a case of good news is good news, and obviously bad news is bad news, with a focus for equities at least more on the macroeconomic backdrop that the report points to, rather than any potentially more dovish policy implications stemming from soft data. Although given the frankly ridiculous amount of event risk that is currently on the horizon, I think conviction behind any moves is likely to be somewhat lacking. And in terms of the Fed outlook, I think the bar for another 50 basis point cut is very, very high. My base case remains that they go 25s at every meeting until next summer when they get back to a more neutral setting. Although nonetheless, if we were to get a downside surprise, the doves in the market would probably go and price a greater chance of 50 anyway, even if policymakers are unlikely to overreact to what is going to be a very skewed and frankly very messy jobs report.
Yes, as if this one didn't need to be even more of a lottery than it already is. But I think you're 100% right. I think the big risk here, the big price risk, is if all those fears aren't seen. If we get a really strong number again, like we did last month, another 200 plus 250, something like that, because everyone is looking for the negatives in this. They're looking for the skews from the weather, the skews from the strikes, a bit of a pullback from last month's big number. So really, the market is taking a real sour view of this one, or expecting a pullback. So if it goes the other way, the market's going to be surprised. But it is going to be a report where you're going to have to question whether you can really trust it or not. If the trend continues after all these events, after strikes, after the weather events, we might have to wait until sort of January before we see a straight picture as to what the jobs market is doing. But don't rule out if we get a really stinky number. We're still expecting, a plus 110, 114. If it comes out a negative number, that's going to be a bigger negative shock than anyone's even expecting with these skews. So it's the NFP. It can always surprise us. But I think in this case, an upside surprise is probably going to be the biggest market mover here.
Yeah, I would tend to agree with that. Anyway, we've got plenty else besides this week, Ryan. So you've got 2.5 minutes to try and make sense of it all. Good luck.
Hey, come on, you took 8 minutes to go through your budget stuff. So I've got a bit of leeway on my one. But yes, it's the last week of the month. We have month-end flows obviously going through as well, but it's a big data week as it usually is. So I'm going to take a look at some of the other market moving data points. Today, Tuesday, we get US consumer confidence and the JOLTS data. Consumer confidence is expected to improve from last month's dip, but only marginally. Keep an eye on the 1-year CPI expectation number, which increased to 5.2% last month. Much like NFP last month as well, JOLTS surprised to the upside. And like the NFP, expectations for it to pull back somewhat. However, remember that the JOLTS data lags the NFP by a month, so we're getting September data for that, whereas we're getting October data for the NFP. On Wednesday, we kick off all the Q3 GDP flash numbers starting in Europe, so we get a look at what problems the ECB are facing. We also get the new regional CPI numbers from Germany. Later on in Wednesday, we get the ADP, which I know Michael loves, and then we get the US GDP flash number. Thursday, it's Bank of Japan Day, and no, I won't be awake for that one. In Europe, we get the country and pan-Eurozone CPI flash numbers. Then in the US, I like to look at the Challenger layoffs, which have been running much hotter over the last few months. After that, it's the good old PCE data, and both headline and the core number are expected to drop a pip each to 2.1% in the headline and 2.6% in the core number. We remember back to the CPI data where we saw a softening in the headline number, but the core stayed unchanged. So it's a similar pattern, perhaps, that we need to look at from this PCE data. And Friday, it's finals day for global manufacturing PMIs, concluding post-NFP with a big ISM report. Now, unfortunately, this month the ISMs are coming after the NFP, and it's a bit unusual to have the NFP on the first of the month when it's a Friday, but I'm not sure if that's maybe a bit of an election shift because of the data and just to keep it out of the way of the election next week. So we've got lots to get our teeth stuck into before we head into the US election week, and I think this is maybe the last chance to do a bit of fundamental trading before the market shifts fully into election mode.
The payrolls is actually nothing to do with the election. It would always be on the first. The reason for that is, for the data nerds out there like me, the way that the release date of the non-farm payrolls print is calculated is that it is always the third Friday after the end of the survey week, and the survey week is the one which has the 12th of the month in it. So it's just the way that the calendar has fallen, is that 3 weeks on is the first.
Well, see, that's a new one, because I always thought they didn't put it on a Friday when it's the first of the month. But we'll agree to disagree on that one.
Well, there you go. You come to the trade-off not just for macro strategy and trade ideas, but for a learning experience as well. Speaking of trade ideas, should we get into some charts?
Let's.
Right, crude. I'm going to start with WTI. We saw a slick move at the open on Sunday with WTI barreling lower.
Right, wooden cards.
So I knew. I couldn't even say it with a straight face because I knew that something was coming there. But I don't want to spend all the time making crude puns, because we are dealing with serious geopolitical matters, and of course that is the weekend Israeli response to the Iranian missile strikes that were launched towards the start of the month. And it appears that this response has been substantially more limited than market participants had been worried about. The strikes from Israel focus primarily on military targets, not on any oil or nuclear infrastructure. And as a result, it looks like it's more about sort of saving any face than escalating tensions further. As a result of that, we've seen a significant geopolitical risk premium priced out of both Brent and WTI. And really the floor that had been under prices has just been taken away very, very rapidly indeed. WTI down about 6% on Monday. That was the biggest daily decline since July of 2022. And it looks like, for now at least, the bears are in control of things. We are below, or we settled below yesterday, the December 2023 lows at $67.70 a barrel. So perhaps we are looking now for a return back towards the $65 a barrel mark. Although, of course, the standard health warning must apply that although the market's perception of geopolitical risk is that it has subsided, the situation remains very, very fluid indeed. So those who are short crude may want to perhaps hold those positions for less time than they usually would, given the elevated degree of risk that is still out there.
Yeah, well, this one's gone exactly as we've been speaking about over the last few months, actually. You know, when there's an easing up in the tensions in the Middle East, the market craps out because it switches straight back to what's going on the demand side and the fundamentals. And as the fundamentals are still weak, China, still very weak, and manufacturing PMI is still in contractory territory, there's no reason why oil should retain a bid afterwards. So it's no surprise to see it down here. We'll have to see whether Biden and his trading platform is open, because he might like to pick some up down here for the SPR. But 66, 65, big level. And they've got that sort of double bottom around the 64s, but the longer standing level is around that 66, 67 area. So if that goes, then we could be heading much, much lower.
Indeed, yes. Right, moving on, the cross that doesn't move.
Yes, and I'm asking, will it be budged by the budget? There you go. There's my pun for the day. You can have that one for free, mate. And it is in one of its do nothing phases at the moment. It's been that way for most of October, apart from the quick rally we saw above 84s. We've been going pretty much sideways since. Now, with Europe not looking its best fundamentally, and the UK heading towards what's expected to be a tax hiking budget, there's a good reason why we're sitting in limbo at the moment. But there's equal risks that we might see a big move this week. For the downside, Eurozone data, especially inflation, could raise cut expectations for the ECB if it's much softer than expected, especially as they've been telling us they're expecting inflation to pick up into the end of the year. And the UK budget, it might not be as bad as feared. That might finally see support breaking and the pair heading towards the next big support level down at the low 82. So that'll be a break from where we are now down through 8300. For the upside, inflation rising in the Eurozone and a bad UK budget could see us retesting or breaking back up through the 84.20 area. For me, I like trading this one, but I'll be looking to trade this one more from a break standpoint rather than getting in before it happens. So I'll be looking to see if we get a move either below the 83 figure or back above 84.20. And if I see those breaks and it starts to hold, I'm going to probably have a go at trying to trade with those breaks.
Yes, indeed. I mean, if good news from the budget, that might be in short supply, but only time will tell. I mean, things aren't particularly great in the Eurozone either, if we're being completely honest. Right, the equity space, the S&P 500 losing ground for the first week in 7 last week. Not particularly surprising, to be completely honest with you. I think we were actually discussing this time 7 days ago how it wouldn't be overly shocking to see participants take some risk off the table into the election. Incidentally, I was running the numbers on this yesterday. The S&P is up about 23% year to date. That is the best performance, year-to-date performance at this time in an election year since at least the turn of the millennium. So that's 6 electoral cycles now. And it's no surprise that you participants want to take a little bit off the table, given the uncertainty that we have lying up ahead. But of course, the medium run bull case, that remains intact. Economic growth is still very, very strong indeed. We're likely to get a GDP print in the US north of 3% this week. Earnings growth is still pretty solid, just shy of 4% on an annual basis so far in Q3 reporting season. And of course, the Fed put is still there and intact. From a technical perspective, the decline that we saw last week, we held the prior all-time highs around 58.30, 58.50. So everything does align for further upside, but I do think that conviction is likely to be lacking until we have some certainty over the election and we're out the back of this sort of nightmarish 6-day stretch of payrolls break, election break, Fed end. You've also got 5 of the Magnificent 7 reporting earnings this week. And of course, that is something that participants are going to be very, very cognizant of. So while I remain bullish over the medium and of course the long term, I do think perhaps a little bit more de-risking could well be on the cards in the short term, if nothing else.
Yeah, it's obviously going to be very messy, the election. I think if you try and want to put it in simple terms, if it's a Harris win, then that's, potentially a carry on with the status quo. So then that's a green light for stocks to continue because it's no change in any sort of policies or anything like that. Obviously, a Trump win is the big unknown. And, is the market going to like it? Is it not going to like it? His sort of protectionist policies are going to impact a lot of the international companies that make up US stocks, firms in the US who trade abroad and have big exposure abroad. If he really goes protectionist, is that going to cut a lot of income from some of those big stocks? And then that's potentially going to be negative. But on the flip side, he might be a more, growth looking at potential for the US. And if the market sees it in that positive light, then they see that positive for growth and then stocks rise. So whichever way you look at it, stocks, there's more reasons for stocks to continue going up than they are going down. And while that remains, that's what's going to happen.
Indeed. I mean, I think that is the case 90% of the time. But anyway, I think with the election, we'll probably talk about this more next week. I think for me, the market just wants certainty. You're not necessarily particularly bothered about who wins. It's more a case of, do we know who the winner is and do we know that in good time? I think that's the bigger concern. In any case, let's go down under.
Yep, going to have a look at the Aussie dollar because it's looking in a bit of trouble right now. We've just broken through the 61.8 fib of the August move that was down at 65.75, and that's also a level all on its own that stretches back a good couple of years. So it's a pretty significant level. The Aussie dollar is obviously a commodity play as well, and commodities have been moving around a lot. So Aussie dollar will follow too. And a lot of that is tied up with what's going on in China. So weakness in China obviously means weakness for some commodities, and that means weakness in demand seen from their top producers like Australia. So China's not buying as much from Australia as they used to. Of course, this pair does have the US side of things to deal with also. So it's not like all Aussie dollars are the same either. For example, Aussie dollar's been holding up better versus the Kiwi on the rate divergence trade. Suffice to say that this pair, it's been pretty much one way since we hit the 69s, and the break of this fib is a strong signal that we're likely to continue to remain bearish. However, if we do bounce, we need to get back above the 66 figure, 66.20, then 66.50, and these are just first steps to turn around this trend that we've seen so far. If we don't do that, then the downside remains the path of least resistance. The next support I see around here or below here is an old zone, an old traffic zone I got on my chart there, down at 65.20.40. So if we hit that and bounce from there, then maybe we see a bit of a turnaround. Otherwise, we're potentially going to be heading much, much lower. You need to watch the data closely for this one, because the RBA is still one of the most hawkish holdouts. But if they start to turn dovish, as I expect they're going to be forced to soon, we could be going much, much lower. So it's not looking good for the Aussie at the moment.
The RBA are a baffling one. I know we've got inflation figures out of Australia this week, but it just seems bizarre that they're sticking resolutely to this hawkishness, because it's not an economy I follow particularly closely, but just a quick glance at the data would suggest that we are well on the way back towards the target range, and they're just boxing themselves into a corner where they're going to end up having to cut pretty aggressively, pretty quickly, probably in early 2025. But then again, if you listen to RBA's former governor, Philip Lowe, they weren't even meant to be hiking rates at this point, were they, given that guidance, the infamous guidance that he issued a few years ago?
Yeah, I mean, I was laughing at that guidance when he was giving it out. They said they weren't going to hike to at least 2024, and okay, they haven't started cutting yet, but I think you're right. I think they are boxing themselves into a bit of a corner, and if the data does turn, there's no reason to suggest why it shouldn't, given what's happening in the rest of the world. Then they're going to be playing catch up pretty quickly.
Indeed they are. And in any case, Philip Lowe has ridden off into the sunset to go and work for some investment bank. So I doubt he's particularly bothered at this point. Right, let's get on to our plays of the day. Okay, so the dollar for me this week, the FX market at large continuing to focus largely on growth differentials as opposed to what's going on with monetary policy. And that is continuing to benefit the greenback, with last week taking us north of the 104 figure and also north of the 200-day moving average for the first time since early August / late July. And of course, you've got a little bit of pre-election hedging and de-risking, which is giving a little bit of a helping hand as well. Things are still looking pretty good for dollar bulls at the moment. So I think for me, as long as we remain above that 200-day moving average, which is around 103.80, 103.85, then I would be remaining long and certainly looking to buy into dips at this moment in time. And of course, that comes ahead of the non-farm payrolls report on Friday. So this is perhaps more of a short-term view than I would usually offer. But for the meantime, I think long and strong in the case of the greenback. Ryan, you're looking at dollar Hong Kong.
Yeah, long-time viewers might know that I like to trade this pair now and again. Firstly, I probably need to give some background for those that may not know. The Hong Kong Monetary Authority, HKMA, runs an FX band for the dollar Hong Kong in the 775 to 785 range, and we're approaching the bottom of that band now. They have been pretty resolute in maintaining this band since 2005, and they've taken a fair few speculators to the cleaners who have tried to trade a potential break. Carl Bass was the last big name to have a go and come up short, shall we say. I traded this last when we were up at 785, and I'm going to trade it from 776 down to the lower end, down to that 775 area. Now, I should warn you, though, that as much as it looks like a surefire trade, there is always a risk that they do decide to adjust it or end the band. And that risk is maybe now a bit higher given what China are throwing at their economy to try and perk it up. and that economy obviously now includes Hong Kong these days. So there is never a completely risk-free trade, but this may be as close as you might get to one. So it's a good low-risk trade, but make sure you've got your stops pretty tight in case something untoward happens.
Yes, indeed. Pegs are a surefire thing, and until they're not, I suppose, as we saw with the SNB all those years ago. In any case, that does bring us to the end of another show. Thank you very much, as always, to Ryan Littlestone from Forex Relied and Forex Analytics for joining me. Thank you to our producer as well, Kyriakos, for bringing things together as brilliantly as always. And of course, thank you very much for watching. If you've enjoyed the show, drop a like on the video, leave a comment as well. Let us know how you're trading the markets. It is, of course, a very busy week ahead, and we'll be back this time next week to try and make sense of it all and preview another incredibly busy week for the financial markets as the election looms large in the United States. In the meantime, have a very good week ahead. Thanks for watching, and goodbye for now.